Thank you for joining our webinar this morning. My name's Aidan Smith. I'm the head of not-for-profits here at HLB Man Judd, and I'll be your host this morning. I'd like firstly to acknowledge the traditional custodians of the various lands in which we work today, and the Aboriginal and Torres Strait Islander people participating in this webinar, and I pay my respects to elders past, present and emerging, and recognise and celebrate the diversity of Aboriginal peoples and their ongoing culture and connections to the lands and waters of New South Wales. Now, before the big introduction to our guest speaker this morning, we've got some news hot-ish off the press. Only last week, the Client Choice Awards 2022 were held, and HLB Man Judd was named the best accounting and consulting firm with revenue between 50 and 200 mil. That's the 9th time we've won that award. So thank you very much for all who voted for us. We really appreciate your support. We're very proud to be part of a team that care about you and want you to help improve. So thank you again for that. It means a lot. So what are we doing today? Well, we're presenting Not-for-Profits Financial Reporting Update. Just a bit of housekeeping before we get started. We've got, you see at the bottom of the Zoom screen, you've got the Q&A box. If you type in your questions there, don't type them in the chat in case we miss them. So the Q&A box, type them in there, and then we'll go through them at the end of the presentation. Now, for a presenter, if I said that our presenter is a member of GAAP Consulting Network, principal of Australian Financial Reporting Solutions, and a former member of the Australian Accounting Standards Board, you'd say this person must be a genius. If I then added that this person's excellent knowledge, financial reporting through significant experience with several major accounting firms in both the external audit and technical divisions, and has spent significant time analysing and interpreting accounting standards for clients, you'd say, I hope this person's presenting to us today. If you haven't guessed who it is already, you probably haven't either read the invitation or read the screen in front of you just now. We're very lucky to have Carmen Ridley to present to us. And Carmen, I'll now hand over to you.
Thank you, Aidan, and welcome everybody. So as Aidan mentioned, we are going to go through a bit of a financial reporting update. Just the normal disclaimer, this is for training purposes only. I'm not giving any specific advice here. I thought the way I'd split today's session is to talk about it in years. So we'll look at what's relevant for 2022, and then we're going to have a look at what's relevant for 2023. So looking ahead a little bit. Now, I know over the last few months, you've had some sessions from Mel Yates from the ACNC, and some of what I'll be talking about, he would have covered. So I think I'll probably hit it from a slightly different angle. I've heard Mel talk a little bit and he's heard me talk, and we generally complement each other. And Freddie, some of the discussions that you had with him around tier 3 proposals, probably not going to go into it in great deal of detail, but if anyone does have any questions, I can give you a little bit of an update. The AASB does have a board meeting tomorrow, and those proposals are just there as well. So 2022, what do we need to be aware of? The ACNC reporting thresholds have increased. So hopefully you are all familiar with this, particularly if you are impacted. So there was a review a significant number of years ago now, which did propose increase of these thresholds, and it's taken some time for them to come through. One of the things I do want to comment on is a lot of the correspondence that is coming out from the ACNC. Their wording can be really confusing because they talk about the 2022, 1st of July 2022. That's the date that the legislation actually becomes effective. So because that's the date it becomes effective, it doesn't mean it's the relevant date for financial reporting. The relevant date for financial reporting is 30 June 2022, so the 2022 AIS period. So these are effective for the period we are in at the moment. As you can see, the small threshold has increased, so that's moved from 250,000 up to 500,000, and the large threshold has moved from 1 million to 3 million. So what's the impact? What if you've now become small? You were medium and you've now become small. That means that you actually don't have a statutory requirement to submit an annual financial report to the ACNC. So there is no requirement to have that reviewed or audited. What we are finding, however, is that many of these charities who've already been preparing the annual financial statements kind of like that check at the end of the year, whether it's via review, whether it's via audit, because you've just got that independent look at the financial statements. So whilst for statutory reasons, you don't have to lodge your financial statements, all you have to lodge is an AIS, there is nothing stopping you continuing doing what you were doing. So what if you have now become medium. You were large and you've now become medium. Well, again, if you're a large charity, you had to be audited. If you're medium, you have a choice between an audit and a review. Interestingly, I don't see a lot of charities who actually choose to be reviewed. Most of the charities that I look at generally are audited. And I think that's partly because there isn't actually that much difference in fee between a review and an audit, but you get a lot less level of assurance. So again, you can completely choose to stay having your audit. You still have to do your financial statement. So it's the level of assurance only that changes if you were large and you've now become medium. So that's the thresholds kick in for 30 June 2022. So just make sure that you are aware of your obligations under those new requirements. A new requirement that has come through is to do with KMP remuneration. Now, a few years ago, we talked in these sessions about how the ACNC were encouraging related party disclosures. And I made the comment at the time, and I said, what the ACNC generally does is they put things out that are encouragements and voluntary, and they kind of see what the take up is, and they see what information they're getting back. And often a few years down the track, we see that that requirement becomes a mandatory requirement. That's exactly what we're seeing with related party disclosures. So I've got a little bit in this section and I've got a little bit in our 2023 section because they've structured, or they've staggered rather, the implementation date. So if an entity, if a charity that is registered with the ACNC is preparing special purpose financial statements. So remember that charities or not-for-profits can still continue to apply the reporting entity concept to determine if they can do special purpose or general purpose. So if a charity deems they are a non-reporting entity and therefore wants to prepare special purpose financial statements, they can. And there's discretion about disclosure in the accounting standards. The ACNC, however, have said we are removing discretion around disclosure of KMP, so your key management personnel. Within any organisation, the board of directors or the equivalent governing body is always a key management personnel. Other than that, it's the discretion of the entity who chooses who the key management personnel is. So it's persons who are responsible for directing, planning, directing and controlling the activities of the entity. It would generally be a CEO, a general manager, that equivalent person. And then depending on the charity, it may go down to direct reports to the CEO. It's a charity decision. As I say, I would expect that to be documented. So what effectively the change that the ACNC has introduced is said, if you are doing special purpose accounts, that's great. We're not going to stop you doing that. But you effectively have to include related party disclosures as if you were doing general purpose accounts. Now, the reason that there's two standards on my slides, I've got AASB 124, which is our related party disclosure standard, and I've got AASB 1060, which is our tier 2 standard. We'll talk about that next. The regulations aren't very clearly worded, but we understand that the Commissioner is going to confirm that you can choose either the related party disclosures from 124 or the related party disclosures from 1060. To be honest, there's not a huge difference between the two. So you still need to disclose that KMP. It's about whether you would disclose them broken down into the different categories, although for not-for-profits, there probably isn't many of the categories that are relevant, or whether you disclose it as an aggregation. This is relevant for all large charities. However, the ACNC has put an exemption in there, which doesn't exist in the standards. It is an ACNC exemption. And they've said, if you are a large charity with only one member of the KMP who is remunerated, then you are exempt from these disclosures. And the reason for that, and somebody was saying to me the other day when I was discussing it, well, for-profits don't get that exemption, so why should we give that to the not-for-profits? For-profit entities generally remunerate their directors, so it would be very unlikely there would be only one remunerated KMP. Whereas in the not-for-profit space, your directors are often volunteers. So it is quite likely you could have zero payments to your directors. You've deemed that your CEO or your general manager is KMP and they are remunerated. So it seems a little bit unfair that that person has their remuneration disclosed when that wouldn't happen in a for-profit space, and it wouldn't happen if you were paying the directors. So there is that exemption there. In addition, in year one, again, we are expecting the ACNC Commissioner to put some more guidance out on this, and expecting them to say that comparatives are not required in year one. Going forward, comparatives will be required, but they're not requiring you to reconstruct those comparatives in year one. So that's our KMP remuneration. It will be required for 30 June 2022. If you are currently preparing general purpose financial statements, this change is not relevant to you because you are already complying with the related party disclosures. So it's just to bring all registered charities with the ACNC who are large up to that level. Remember, we've just talked about the large threshold has changed, so it is revenue greater than $3 million. So let's move on and we'll have a look at the new standards that are in place. Now, over the last few years, we've been talking about lots of new standards. You would be sick of hearing about revenue, about leases, etc. So this year, I'm telling you that there are 5 standards that are in place. I'm also going to tell you that those standards pretty much don't have any impact for the audience for today. So the first 3 all relate to the removal of special purpose for certain for-profit entities and relate to the new tier 2 that we will talk about. There is one on there that talks about specific for not-for-profit, so 2021-1. It's effectively just a minor disclosure, and what we realized when we first drafted this standard, I was on the board when these standards were first drafted, is that we'd inadvertently excluded not-for-profits from something that could make not-for-profits life easier when they transitioned from RDR to the new tier 2. So all that amendment is just a minor tweak to actually make it easier for you, and that you don't have to restate comparatives in certain instances. So while I'm saying that the standards themselves don't have any impact in respect of recognition and measurement, your numbers won't change. We will talk about next what happens if you are currently doing RDR. That is the only time you will have some change, because the move to general purpose accounts impacts for-profit entities only. The 4th one on there about COVID-19 is a standard that mandatorily becomes effective at 30 June 22. However, anyone who was impacted by this early adopted the standard. So this was a standard we talked about previous sessions, that if you had received a rent deferral or a rent waiver because of COVID-19, you were able to account for it as a change in variable lease payments rather than a modification. So that was put in there to make life easier for everybody. The cutoff date is 30 June 22, so it was any deferrals or waivers up to that date. So even though that's the mandatory date, as I say, I would expect anyone who's impacted to have early adopted that, so it shouldn't have any impact either. The last one is to do with tier 2 disclosures. If by any chance you were impacted by the removal of LIBOR, which was an international interest rate benchmark. Other than financial institutions, I don't think I've had any of my clients who've been impacted by it at all. And Aidan's shaking his head, neither has he. So again, don't expect it to be any change for you. So if you are doing special purpose accounts, nothing has changed other than the disclosure of KMP remuneration if you are large. If you are doing RDR accounts, we will talk about that change next. But for everybody, it really is the opportunity, given that we've got no major standards, to take that step back and to read your financial statements. I know it may not be the most exciting read, but let's try and get them so they're actually as meaningful as we can be, to remove the clutter, to make it so the financial statements are as plain English as possible, rather than just rolling them over. I would really strongly encourage everybody to have a look, even if you just pick one section, even if you just pick revenue, for example, and you go, let's read all the information about revenue, and can we make it a little bit more plain English? So if you are currently doing RDR, you do have a change this year. And we've talked about it previously and said that RDR will no longer exist. So what I'm going to do is talk about what does exist, and then how do we move from our RDR to our new tier 2. Bit of background first of all. So we, or the board at the time, was removing the ability of certain for-profit entities to do special purpose financial statements. And as we were working through this, as we were doing a lot of the research and we had a lot of stakeholder discussions, What we determined was that there was not a lot of for-profit entities who had moved to tier 2. They didn't think it was a big enough drop from tier 1 to tier 2, and there was too much disclosure for them to move to special purpose to tier 2. Different from what we saw in the not-for-profit space. So as a board, we said, okay, well, we need to really review tier 2. And the approach that we took to adopting the new tier 2 or writing the new tier 2 is to start off with IFRS for SME. So IFRS for SMEs is an international standard. And by SMEs, we mean the entities below the listings. So it's not the mum and dad type organizations. It is probably one of the most plain English accounting standards that you will ever see. So what effectively we did is we picked all the disclosures out of that standard and used that where recognition and measurement was the same. We tweaked it slightly where recognition and measurement was different. And we also said, is there any Australian specific disclosures that should be included? And we used things like audit fees. So the disclosure of audit fees is not required internationally, but we do require it in Australia. So different approach. It was a bottom-up approach for the new tier 2. As opposed to RDR, which looked at all of the accounting standards and shaded the bits that were no longer required. So we'd still have our 2 tiers. I would be strongly encouraging the not-for-profits who are doing general purpose to still stay within tier 2. I don't think you need to jump up to tier 1 unless you deem you are publicly accountable. So if we're in that tier 2, your numbers won't change. So if you were doing RDR previously, if you deemed yourself to be a reporting entity, your numbers are identical. If you were consolidating, because of the ACNC ability to do that, you have to apply to the ACNC to be able to lodge group accounts. You would still do that. If you choose not to do that and you lodge a single entity, you still do that too. Most of the presentation is the same. I am going to talk about an area where it's different next, and then the disclosures are different. So depending on which transactions and balances you have, it depends on how different the disclosures are. So we're going to focus on a couple of areas and have a look at some of those changes. There are a number of model financial statements that are out there. There are a number of documents which compare RDR to SDS for for-profits and for not-for-profits. So if you want that resource, there are certainly lots of things that are available for you. So what if we are currently doing RDR? What do we do? So hopefully you've got the message that you can't do RDR anymore. So we have to change. So RDR as a framework will not exist. So it cannot be referred to within your financial statements for 30 June 2022. So you have the opportunity as not-for-profits to say, okay, are we reassessing that whether we're still a reporting entity? My personal view is I think if you said in the past that you are, if you said it's reasonable to expect the existence of users, I think it's very hard to go backwards. And in fact, I would encourage everybody who is listening that if you say that you are not a reporting entity and you are doing special purpose financials, just make sure that you're regularly checking that. Because if you are a registered charity with the ACNC, if you do get tax deductible gift recipient status, I do think it's reasonable to expect that somebody might look at your financials. If I was a donor, I may want to look at those. So I would encourage you just to reassess that. As I said, there is no change to the numbers. So you move to SDS, your financial statements will refer to these financials have been prepared in accordance with Australian Accounting Standards - Simplified disclosure. Your audit report will refer to that. If you do put any sort of declaration in there, that's what that will refer to as well. So it's just a matter of seeing what the different disclosures are, but there is no change to the numbers. And that's often where the work is changing those numbers. So that is not required. So let's have a look at some of the differences between the two. We are all used to having 4 primary statements. So I'm going to use my terminology. We're used to having the income statement, the balance sheet, the cash flow statement, and the statement of changes in equity. Under simplified disclosure, you can now choose, if you meet certain criteria, to just have 3 primary statements. You'd have your income statement with a bit added on that we'll talk about next, your balance sheet and your statement of cash flows. We get to chuck away the statement of changes in equity. So the ability to do that depends on what your movements in equity are. So if the only movements that you have had during the year are in one of these 4 boxes, Realistically, you are very unlikely to be paying dividends as a not-for-profit, so we can cross that one out. So if all you've had is your result for the year, you may have corrected some errors, hopefully not, but they do happen, and you may have changed an accounting policy, not in accordance with the change in accounting standard, because there isn't any changes. You may have chosen to do so. But it may be that all you've got is your profit for the year. So what you can choose is to present a statement of income and retained earnings. Now, those of us who are listening who remember the standards pre-IFRS, so pre-2005, will remember that it's effectively what we used to do within Australia. So what we have is our normal, in inverted commas, income statement, which is our revenue, takes us down to our profit for the year, our result for the year, depending on your terminology. And then underneath that, we have a retained earnings reconciliation. So it is entirely your decision whether you present this or whether you continue to present your statement of changes in equity. What it does do is, for lots of not-for-profits that I review their financials, the statement of changes in equity just has two columns. It has one column that says retained earnings, one column that says total, and it has retained earnings at the beginning of the year, profit, retained earnings at the end of the year, and goes on for 2 years. So it's half a page. Doesn't really tell you a lot. So I think personally it's a much neater way of presenting it this way, but entirely your decision on whether you choose to do that or not. So we'll see what happens when these come through. I haven't seen a huge amount of not-for-profits early adopt this standard, so I can't comment on what we're seeing come through, but it is your free choice. So what else will change? What I thought I would do is just pull an extract from a note 1. So this is just a generic set of financial statements, a model account that I've been involved in. So a few things to be thinking about. We need to make sure that we do refer to the type of entity and where it is registered and domiciled. That is an extra disclosure that is included within SDS. It probably wasn't in there so much in RDR, and that's because it is an Australian specific disclosure. So the general premise for RDR was all Australian specific disclosures were taken out. But SDS, we've realised that it's quite an important disclosure, that people should know what type of entity we're looking at and where it is registered and domiciled. Principal activities. This isn't actually an extra disclosure that is required under SDS, but it is a disclosure that is missed quite a lot, and that's why I've put it in here. So what the standard says is that you need to include the principal activities if they are not included elsewhere in the information presented in the financial statements. So the reason that a lot of entities miss it is a lot of model accounts are based on for-profit entities. And for for-profit entities, you often have to do a director's report. The director's report includes the principal activities. So therefore, it's not included within the financial statements. ACNC entities do not have to do a director's report. And if you do choose to do some form of director's report, it's not in accordance with the Corps Act. So just make sure that if you haven't described your principal activities elsewhere, we do include that. It is really useful information to the users. I often read not-for-profit accounts and I don't know what they do. Some of them are fairly obvious, but others, I just don't know what this particular entity does. So I talked about what you would refer to, the how you put your financials together. You can see the next red highlighted is Australian Accounting Standards - Simplified Disclosures. And that's the terminology that we will use in here, in your auditor's report, and in any responsible entities declaration. Oops. There we go. I thought I'd pick leases as well, because leases is another area that we've seen that had some significant impact for not-for-profit entities. So I've split it into what is no longer required. So you are not required to reconcile your right of use assets from the prior year. I think what we'll find is people will probably do it anyway because it's in their format, it's set up that way, but it's not required. We're also no longer required to provide the total cash outflows from leases. So there is a requirement at the moment in the cash flow statement, you show the leases, but you do also have to say what's your total cash outflows. And that includes from short-term leases and from leases of low value assets, whereas the breakup in the statement of cash flows only includes those leases you have recorded on the balance sheet. So it's an extra disclosure that can be a little bit awkward to put together sometimes because it doesn't come directly from your lease liability and your right of use asset. There is, however, a new disclosure in respect of leases. And what you are now required to do is do a maturity analysis for your lease liability. So for leases that you have booked on the balance sheet, you are required to break them out into when that is required to be repaid. You will see that I have got an amount in that total column that does not agree to the amount that is booked on the balance sheet. And that's because the maturity analysis is done on an undiscounted basis, whereas the lease liability is discounted numbers. So you should always expect that your maturity analysis numbers are higher than what is on your balance sheet because we do not discount them. Just some other changes on my asterisk. It says this is not exhaustive. I just picked up the ones that I thought would possibly be relevant to a number of the not-for-profits listening. So the first thing is our borrowings. We are required to disclose any breaches and defaults. Hopefully you haven't had any, but if you have, we are specifically now required to disclose that. As I mentioned earlier, we are required to disclose audit and non-audit fees. If there has been any non-audit fees, they are required to, the nature of those are required to be described. So that was not a disclosure that was required under RDR. Some entities may have chosen to do it, but it was not required, whereas it is now explicitly required. And the address of the registered office if it's not disclosed elsewhere. So you may find that you've already got that in some of the earlier parts of your financial report or the document that goes out with that. But if not, we do have to disclose that. We're not required to break down any costs that we've capitalized in relation to revenue. So remember, under the revenue standard, if you've incurred costs, but you can't recognize the revenue until later, you are able to capitalize those. And under RDR, you were required to break those down and give descriptions of them. That is not required anymore. You are also not required to break down your fair value of your receivables and the maximum exposure to credit risk that you might have. So just picked a couple. There isn't a huge difference in the not-for-profit space between RDR and SDS because your transactions are generally much simpler. If you start getting into really complex financial instruments and huge amounts of impairment, we start to see more differences in the disclosure. But in the not-for-profit space, you hopefully will not see a huge change. There will not be a huge amount of effort to transition from RDR to SDS. So a few overall comments just on 1060. As I say, generally there are less disclosures, but it really very much depends on the entity. One thing that is worth noting, and anyone who's heard me present before on financial statements, I'm always very much saying you need to tell me the story. Tell me the story of what's happened for the year. I've pulled in from 1060 that whilst the disclosure objectives haven't been carried through to 1060, and they're the bit that says, when you're talking about revenue, please make sure you've explained everything to do with revenue. They haven't been carried forward. But we very much have a paragraph within 1060 that says you need to present everything fairly. And if you've worked through all these disclosures and it doesn't tell me the story, you need to put them in. So my overall comment about please make sure you've still told me the story is still very relevant under 1060. We haven't lost that. Our standards are only ever a minimum level of disclosure. So that's a transition to tier 2. So as I say, those of you who are listening currently doing RDR, that's the change that you will have. Anyone listening who is preparing special purpose, just a reminder to just keep revisiting that non-reporting entity classification that you have self-assessed yourself to be. The other thing that I just want to talk about in respect of 2022 is an agenda decision. Now, I'll give you a bit of a quick overview on what an agenda decision is. There are lots of entities internationally using the international standards. And anyone who's using those standards can write into a group called the International Interpretations Committee, and they are part of the International Board. And they say, this isn't clear. We just don't understand what we have to do here. We need some guidance. And the International Committee will often contact the national standard setters and say, how prevalent is this in your jurisdiction? Is it something we need to look at? Depending on what comes back, that committee has a range of options. They can flick the issue up to the International Standards Board and go, you've got a big deal here, sort it out. They can decide to issue an accounting interpretation. We don't have very many of them, but we do have some. Or they can decide that they've looked at the issue, they actually think it's clear within the standards, and therefore they are not going to add the issue to their agenda. That is why it's called an agenda decision. That is what we see most commonly occurring. These agenda decisions have been around for a number of years, and it's generally techies like me who read them. Nobody else is aware of them until one comes out that causes issues and puts the cat amongst the pigeons. So we had one of these last year, April 2021. And given that we have predominantly junior ends in Australia, this kind of missed a lot of the technical rounds and didn't give people a lot of time to think about it before June. The interesting thing about these agenda decisions is they're not actually changing the accounting standards. So there is no effective date. So they're effective the minute that they are published. So ideally, we would have looked at it last year, but we didn't. We're not necessarily living in an ideal world. So I just wanted to raise this for you this year to be aware of. So what happens is a question is asked to the committee, and then the committee answer that question. And the question that was asked is, we have a customer who enters into a software as a service arrangement with a supplier. Let's use Microsoft Excel because we all know that product. So we have the ability to access Excel, and we access it through a cloud. A previous agenda decision has told us that we don't have an asset. All we have is expenses that we recognize as we access Excel. But what we decided to do is we decided to jazz Excel up a little bit. We decided that when we went in, we really wanted these beautiful fields to pop up, and we populate that, and then it goes behind the scenes into a beautiful Excel database, and it does all that. So we spent a fair bit of money configuring, customizing Excel. It could have been transition costs, transition everything over. So the question that was asked to the committee was, we get that we expense the cost to access Excel, but what about all these extra costs that we've incurred to make Excel beautiful for us? How do we account for that? So what the committee did is give their decision. I've summarized that decision in a decision tree. And there's lots of questions that we need to ask. So this is relevant for you if you have capitalized any costs associated with software, or you might be able to pull some analogies to anything else that you might have done. So effectively, the first question is what you created something that is separable from Excel? You own the code, it sits behind your firewall, you can pull it apart and sell it to somebody else without them having Excel. If you have, you might have an intangible. You probably haven't done that, but you might have done. So we're more likely to lean onto that no side, which says that you don't have an intangible asset. So the next question that we ask is, who provided the configuration and the customization costs? In our example, was it was it Microsoft, or was it random? If it was random person, then as soon as they've completed that work for you, you expense it. So as soon as you've got the benefit of that service, service has been completed, it's an expense. It does not sit on your balance sheet as an asset. If Microsoft did it, the question we then need to ask was, did they provide a distinct service to you? So for example, I wanted to transition my information from an old system to Excel. So Microsoft came along, or an agent of Microsoft, and they got all my information from the old place, lifted it up, dumped it into Excel for me, and it was all working beautifully. So that's a distinct service. If that was the case, it's an expense as soon as you got the benefit of that service. You can see in that box, I've got a reference to note 1, and note 1 is on my next slide, just to give us some factors to try and help determine whether it's distinct or not. If it's not distinct, if it is closely linked to Excel and I can't pull it apart and I get the benefit of whatever they provided for me for as long as I've got the use of Excel, then we still don't have an intangible. But what we do is we say you can recognize that for as long as you are using Excel. So if you paid up front, which you may well have done, you recognize a prepayment and you release it over the time that you are using Excel. So there's a fair bit of questions that you need to ask if you have capitalized any of these costs. I also think this can be used as an analogy for some different areas. So I got asked a question the other day from an entity that was an RTO, a registered training organization, and they have a license, in inverted commas, to use training materials from somewhere else. They're able to customize them, but they're not able to sell them. They don't control those underlying materials. And the question that I was asked was, how do we deal with the extra costs we incur to customize the training materials? We've capitalized the right to use the underlying materials. And I sent them back to this agenda decision. And I said, whilst this specifically covers software as a service, because that's the question that was asked, it's not limited to that. It's exactly the same for any other thing that's similar to this. So off they went back there. Haven't yet heard the conclusion, but I suspect the answer will be that they couldn't capitalize that right to use that training materials either, because they don't control it in an underlying manner. So I said that though note 1 was here. I'm not going to work through this slide. It's more there as a reference for you for after the session. So you can have a look if you do have this scenario. I suspect what will happen is that as you work through my little checklist in inverted commas, you will have certain things that are distinct and certain things that show not distinct. So what you've got to do is look at which side is more compelling. It may well be a judgment call. So it's documenting your answers to come up with why you have made the decision that you have. And if you have continued to capitalize, why that is appropriate. So that's our software as a service agenda decision. As I said, something just to be aware of, because it did fly a little bit under the radar last year. So that's 2022. I'm going to look ahead a little bit to 2023, just so you can start planning for this, because it will come around much quicker than we think it will. Back to the ACNC. So the ACNC have said that they want more disclosure about related party transactions. So why? Why are they so interested in it? Why is this a big deal for them? They have identified, and I pulled some of this information from the ACNC website, they do believe that transactions with related parties are a key risk for charities. They have found that a number of charities have undertaken key related party transactions that possibly the donors wouldn't have been too excited about if they'd known about. And they said in some cases, it wasn't actually an intentional transaction, but there's been benefit given to a related party that doesn't seem to sit within the face of the objective of the charity. So private benefit has occurred. They do acknowledge that sometimes that is an intentional transaction, other times it is an unintentional transactions. And the ACNC is very much about building trust and transparency within charities to make sure that this sector is actually a really well-represented charity that we have comfort in. So consequently, they are worried about the impact if we are seeing a significant number of these transactions that don't necessarily seem to fly in the face of the objectives of the charity. So they're hoping that causing the disclosure of these to go in will actually enable entities to be more aware of it, and also users of the accounts to understand what is happening. So that's the why. The ACNC guidance that has been released has said that for medium and large charities, we do need to be disclosing related party transactions. Now, the reason that we're raising it now is because this is going to be effective for 2023, which kicks in at 1st of July 2022. So you need to be aware of, have you got the systems in place to try and identify these related party transactions? A few years ago, the related party standard became effective for public sector entities for the first time. So we've got a fair amount of experience for moving from an entity that didn't used to track their related party transactions to an entity that did. And what we found worked really well in many cases is a real education process so that the KMP and other related parties understood what type of transactions had to be disclosed. And in many cases, there was forms that were handed to them to say, this is what we know about, but these are the other things we need to know whether any of these things have happened. We need to know about relationships between the entity, the charity, and any close family members of the KMP, for example. So have a think about how you are going to capture this particular information. The ACNC have put some guidance out at this point. We are going to see more guidance on this. We have to, because the guidance that has been put out is not enough. Interestingly, this definition of related parties is not the same as the related party definition within 124. And I don't know if that's deliberate, or I don't know if it's just they were trying to shortcut the definition, because the definition in the accounting standard is very long. So again, we'll see more guidance on that. One of the really important things to remember is in that definition of a related party transaction, it does not matter whether a price was charged or not. And in fact, if you did not charge the other entity for whatever it is you provided to them, it's probably even more important that it is disclosed, because you certainly wouldn't necessarily give things for free to another unrelated entity. So it can be things like you've let a related party use space within your office for free. It can be that you provided management services to them. It can be that there's been, depending on what you do, there could have been some goods that were sold for them at below market value. We're only looking at material transactions, so it is things that we need to could it influence the user? So if it's something that was a transaction between the charity and a related party that could have happened with anybody, the man in the street or the person in the street would have been able to be offered that transaction and could have done it, probably not material. It's where the transaction occurred that is with a related party on terms or conditions that may not be available to every other person. At this stage, the ACNC comparatives are not being required for the first year again. So for the 30 June 2023, you will only be required to disclose related parties for the current year. But then as we move through, you'll have that information. So we'll have to do a little bit other comparatives. So what needs to be reported? I said predominantly it was for medium and large charities. They're the ones who have to give the details of the related party transactions, again, in accordance with one of the accounting standards, 124 or 1060. Now, I made the comment when I talked about key management personnel remuneration, there isn't a lot of difference between the two. There's even less difference between related party transaction disclosures than there is for KMP disclosures. We also, in the AIS, so that has to go in the financial statements. In the AIS, there needs to be a summary of the transactions. So I feel like that's more of a narrative, but again, more guidance coming out from the ACNC. Small charities don't get away with completely ignoring this issue. They have to give a brief description of related party transactions, again, in the AIS. At this stage, we don't know what that means. I don't know if it will require dollar figures. I don't know if it will just require we let a related party use some of our property at a really high level disclosure. So watch this space for that further guidance that will come out about that. So that's just something to be planning for, depending on where you sit in the charity space. The ACNC are going to require this from 2023. So make sure we've got systems in place for 1st of July 22. The last thing I just want to finish up on before we leave some time for questions, so start thinking about any questions that you might have, is hopefully you might remember, those of you who attended last year, I gave some discussion about a revenue project that I was involved in with the AASB and said that we were out there trying to talk to as many stakeholders as possible. Just wanted to give you a little bit of an update on that project because it is pretty much now finished and see what the outcomes were from that. So the purpose of the project was a short-term narrow scope project to look and see what the issues were that we were seeing around the revenue standards, AASB 15 for not-for-profits and 1058. And was there any quick fixes, in inverted commas, that the board could put through to try and assist not-for-profits with some of the challenges they were finding with this standard? I got a significant number of issues that were arising through my discussions that happened. And many of the issues, the board decided that they weren't within the scope of this short-term narrow scope project. So they had to be parked for the post-implementation review that I will talk about next. What did come out of this project, however, is that there were some educational materials that were developed. Now, one of them was a key facts document. The idea of that document was to provide some information, probably for non-finance people, to try and explain, this is why we've got two accounting standards for revenue. This is how the two of them interact. This is how we know if we're in one versus the other. And this is the impact of being one versus the other. It's only a few pages long. It's on the AASB website. But it might be something that if you are chatting to some of the directors who are less financially literate, something that will hopefully give a little bit more of a plain English explanation on these two standards. We've also added an extra staff FAQ, which helps you work through which income streams you even are thinking about for these two standards. So for example, it tells you that dividends and interest are not even within the scope of these, they're in the financial instrument standard. Rent is in the scope of the leasing standard, for example. So they're documents that have been published. There was also some educational webinars that were released. So two of them came out. There was a rerun. So there was an initial one and then a rerun. I understand both of the webinars are up on the AASB website and on the AASB YouTube channel. They are as identical as they can be. I don't ever have speaker notes, so consequently my sessions are never completely identical because I say different things in each sessions. But what I'm saying is you don't need to watch both of them. So they'll be sufficiently similar enough that you only need to watch one. But goes for about an hour and a half. Again, I would encourage you to watch those. It's not changing the world. It's not giving you answers to everything, but it does point out where there is some additional guidance in certain areas, and just to talk through some of the examples for certain things. So the next thing that is coming in this project is the post-implementation review. So the post-implementation review is where standard setters say, we've issued a standard, we've thrown it out there. After a couple of years, probably need to know how well it's going. So the post-implementation review for these two standards is starting in 2022, and the project that I was working on was really the first step to that. So we've got this great knowledge of some of the issues. This will be a fairly major project and will be, from a personal perspective, I think we will see some significant changes to these standards. That is not me answering in any context in my relation to the AASB, but I think we will see a fair number of changes. So it's a bit of a watch this space. I would encourage any of you who are interested in this project, who would like to talk to staff, who would like to have any input, sign up for the weekly newsletter on the AASB. You only get one newsletter a week. It comes through on a Thursday. That will give discussions of any roundtables and things that are happening. Or shoot me an email and I can pass on your details to the staff if you are interested in having any discussions and getting involved in this project. But I do think there's a sufficient number of issues identified that we will need to see some changes in this area. The one other thing that is still outstanding for this project, and I mentioned we've got a board meeting tomorrow and it has been taken to that board, is there was a couple of illustrative examples that were written. They are potentially going into AASB 15 and 1058, just to give you some extra guidance. The board will decide tomorrow whether to go ahead with the release of those examples or not. So we may see some changes to that. So that's all the revenue side. The other thing that I do want to share with you, and it's something that I'm incredibly proud that we've actually got this through, is to do with peppercorns and concessionary leases. So as you would be aware, back in 2018, the AASB introduced an exception that said that if you have concessionary leases, the leases that you are paying less than market value, you can choose to use cost for the right of use asset. You don't have to fair value it. And cost is based on the lease liability. It was always a temporary exemption. It was written in everywhere that it was a temporary exemption. And pretty much every time I speak to not-for-profits, they say to me, when's this temporary exemption going to be lifted? Because there's a massive amount of work. An exposure draft was released that proposed that for private sector not-for-profit entities, that exception was made permanent. As permanent as it can be, the AASB can change their mind whenever they want, but as permanent as it can be. The responses are being analysed, again, going to the board meeting tomorrow, but the board papers are released at public. There was unanimous agreement that this should be made permanent. So I would be staggered if the board did not go ahead and release this through. So therefore, for those not-for-profits who are very heavily reliant on that exemption, hopefully this will remove a huge amount of angst about, do we need to collect fair value information? You do not. That grandfathering is for all leases, both in place now and in the future for private sector not-for-profits. Remember, there are some disclosures around that. So if you do have reliance on peppercorn concessionary leases, you do need to describe the nature and extent of them, the terms and conditions, etc. But hopefully the fact you don't need to fair value them is a big win. So that was all I wanted to talk about. So my details are here if you do, as I say, have an interest in being involved, particularly in that post-implementation review. Either get the AASB newsletter, or if you want to shoot me an email, more than happy to pass on your details. So Aidan, I'm going to throw back to you for any questions that might have come through.
All right, thank you, Carmen, for that. And it's always good to end a presentation and good news about the leases, the Peppercorn concessionary leases. So that is something that some great news you can take back from today's presentation. Now, we've only got a few questions, not many, and I think that's obviously because of the quality of the presentation you gave, Carmen, you've probably answered many of the questions, all of the questions that people have. The one question came through about whether this applies to the ACNC registered entities or all not-for-profits. I think it's very safe to say that everything you talked about, which is the ACNC, which was the tiers,
yep,
applies to ACNC, and the related party information applies to ACNC entities, but everything else applies to everyone. That's safe to say? Yes.
Yep. Yep.
All right. We then had a question about the slides being available. Yes, the slides will be available at the end of this presentation. We also got a question just in relation to, it was about the budget with a capital B. I thought, well, this could be going a bit beyond the scope of what myself and Carmen know. It's about tax incentives for training costs. That's a really quick question for one of our tax experts. So if you want to reach out to Kim Kellaway, and she can put you in touch with someone regarding that. And that's all the questions that we got. So yes, thank you very much, Carmen, for that. Okay, so I'd like to thank Carmen again for our insights this morning. And if you'd like any further information, can you complete our poll question, which has appeared on your screen? Very simple choice you've got here, yes or no. So would you like someone from HLB to contact you regarding today's webinar? Yeah, if you want to discuss anything else, you know Kim's picture, phone number, and email address appears on the screen. Everyone knows Kim very well. She heads the clients and markets here at HLB Man Judd. So if you have anything else, other questions, please reach out to Kim. A recording of the session and PowerPoint slides will be sent to you shortly. Thank you again for joining us today, and we'll see you all again in the near future. Bye for now.